um, in about 5 or so minutes. So we're going to use that opportunity to try to meet those in the room. Is that okay? All right. So can you just do name and organization? That's fine. Yeah. So let me start with myself. My name is. Can you all hear me? Okay. So my name is Martin. Martin Eigbike. I know it's not an easy surname to pronounce, but so in totality, AVP has over 900, or we're affiliated to a global network of over 900 social investors, including some of the largest social investors in the world, really. So for Africa, we are younger than the other investors, and we're just in the process of starting our membership program in a couple of months. But the objective of AVP, our mission really, is to help to mobilize capital flows into Africa to bridge the SDG financing gap. That's basically the mission of AVPA. So we're hosting this session in order to get social investors like yourself to interact more around the topic of co-investment and collaboration. As you know, this West Africa Deal Summit, one of the underlying themes has been around engagements, building the ecosystem, collaboration, and having more people working together to achieve this, to tackle the significant challenges that we're faced with in terms of capital for social investment on the continent. So this session, we're going to look at co-investment as one way of actually getting that collaboration going within the ecosystem. Okay, so I'll just do, since we're small.
Recording in progress.
We will start officially in a few minutes, but I would like to take some quick intros in the room just to know who's sitting here. Thank you.
So I'll just stand up to introduce myself. I'm Nanabe Forsen. I'm with Stanbic Investment Management. So we sit on the pension side in managing pension funds in Ghana, and we do some alternatives as well.
Okay, thank you. I'm Amosu Kevi. I am from Togo, United Nations Region Coordinator Office. I'm here in this session to hear more about building the ecosystem. Thank you.
I'm Dorcas Diallo. I work with Injaro Investment Advisors as a compliance officer.
My name is Sheila Elom-Eni. I run a social enterprise business. And we are located here in Accra.
My name is Jeffrey. I work with ThinkUp Securities. We're a broker, dealer, and advisory firm.
My name is Winfred Kumi. I work with AV Ventures, an impact investment fund manager. Thank you.
Excellent. Thank you.
My name is Sam Achianu. I run the MasterCard Foundation Africa Growth Fund.
Thank you, Sam.
Hi everyone, my name is Habiba Ali. I am the founder of Sosei Renewable Energy Company, a renewable energy company based in Nigeria. We build mini grids, and I'm currently seeking equity.
Thank you.
I'm Zubair Salifu. I work for AV Ventures, an impact investing fund manager in Ghana.
Nice to meet you. Thank you. All right. So I think we're. So no, when I introduce the panelists, I'll introduce the stage. But I think, first of all, thank you all for being here. I know that a couple of other parallel sessions happening, so the fact that you've all chosen to come here, we like that. It's impressive. Thank you so much. And also, we actually have the right people in the room, because this is a discussion around co-investment. So it's a discussion that obviously is of interest to those who are deploying capital directly. So hopefully we'll have an investment director with partnership where your co-funding an investment can be difficult to navigate. So what we want to do today is to just hear from ourselves and from our panel what those challenges have been and how they are navigating that. The whole purpose of this is to be able to live here with a sense of ideas around things, and then I would ask some questions, and then after that, we'll open up the floor after a quick panel discussion. Is that okay with everyone? All right, thank you. So I'll start with Brian, please. Just give us a quick introduction of your organization and what you're doing.
Yeah, good afternoon, everyone. Thanks for joining us. I think we have the right audience. I just wish there were more companies that were looking to raise capital in the room. The issue of co-investment actually, from a private equity standpoint, starts from LP perspective. So I would do the introduction in the context of that. I'm the managing partner for Zebo Investment Partners. I've been in the business for about 20 years. And Zebo focuses on investing in improving food security across Africa. And in doing so, you touch the agriculture value chain, you touch the spend period. Our total AUM is $136 million. And our investments too come with what we call technical assistance facility. So whilst the DFIs and the pension funds are providing the getting cheap financing from institutions that are able to support us, etc., along the value chain. And we've so far invested in about 12 countries across the continent. Thank you.
Thank you. Thank you. Excellent. Thank you so much. Let me come to Andrew. Please go ahead.
Andrew Akoto. I lead the Social Investments Advisory at Injaro Investment Advisors. And at Injaro, our vision is to build sustainable African businesses that create economic and social value. So from that perspective, you could say that indeed impact, social impact is very much in our DNA. I'll just say a little bit about the social investment side, and then I'll speak about at least one of our funds. So on the social investment side, we know that Ghana is resource rich, not least in gold. But what we know is that where the gold is mined, there's very little benefits that accrue to the residents of those catchment areas. We know of at least two situations where the multinational gold mining company or the big mining companies left, and then the communities where they were just came crashing down. I think recently most of us might have heard about what happened in Obuasi. And so, with our social impact lenses on, we're trying to see how best can we also support the multinational mining companies to leave a legacy of positive impact, because every mine has a mine life, and so at the end of the mine life, beyond that, what happens? That is where we are working towards. And so we advise these mining companies on the types of businesses that they can create that can outlive the mines. And then we also manage the actual implementation of these businesses, the setup, everything around the setup to its steady state running and eventual growth, because part of that too is, it's essentially a pipe. We build that pipeline to allow for third-party investors to also come in. So that's on our social investment advisory side. Injaro also was the first investment firm in Ghana to raise a Ghana cedi denominated fund from pension funds. And that was, again, from a social perspective, because we want to build sustainable African businesses that create social and economic value. We know that when businesses take on equity or debt financing that is denominated in foreign currency, the exchange rate pressures puts quite a bit of stress on the businesses. And so in trying to come up with a potential solution to that, we thought that it would be great to raise a fund that is in Ghana cedi, so that the entrepreneur would take the investment in Ghana cedi, return it in Ghana cedi, so that there is less pressure. And in that, we also contribute to a social impact. So that's just a little bit. I mean, we have other funds that we are operating. The ABC fund, for example, is agric specific. That looks at sub-Saharan Africa as the areas for investments. So that's a little bit about Injaro. Thank you.
Thank you. Thank you very much. So, Grace, you can go on.
Hello. All right. So my name is Grace Buaka. I'm with Oasis Capital. So Oasis Capital is a local fund manager based in Ghana, but investing in West Africa. We consider ourselves as SME specialists. So our focus is on SMEs, and that is how we really deliver impact to the ecosystem. We invest the tickets of between 1 to 5 million USD and growing. And we have certain sectors that are sort of our raison d'etre. We are becoming more multi-sectorial. But historically, we've tended to invest in sectors that we call essential services. So these are sectors that, as the average African is moving up and working and moving up in the world, these are the sectors that will take the majority of his spend. And so that's how we think about it. These include things like education. Everybody wants to educate their children, healthcare, financial services, food services. Until recently, we didn't have exposure to primary agriculture, but that's something that we are expanding into. But we have been investing along the food value chain for a while, and then things like hospitality and housing as
Okay.
well. We've invested in Ghana and Cote d'Ivoire for our last fund, $50 million fund, and we're fundraising for another one. We're moving into Senegal, Liberia, and other countries in the sub-region on an opportunistic basis. And in terms of our impact, we think that our investment thesis really is impact, really, especially since we are committed to SMEs. But in addition to that, one of the key things that we track is employment generation, and all the businesses that we invest in. Majority of these sectors, these companies actually tend to be fairly youth-oriented, female, employ a lot of females, and that's something that we tend to track. The impact is inherent within the investment strategy, but we try to track these to reports. And we are committed to this space. We are taking a bit more, like I said, we are going into primary agriculture, which is something that is tough, but we are committed to SME development and to moving the needle in the sectors that will really move the needle for Ghana and for Africa. Education is another one of our flagships. We think that Africa has a young population. If we get education wrong as Africa, we are sort of out of the market. So we are committed to investing and supporting education enterprises to educate and to scale the African youth.
Okay. Thank you so much, Grace. Can we get Deji so we can get into the questions now? Deji, can give us a quick introduction. Tell us about Sahel, and then we quickly get into some of the questions.
Yes, sure. I know many people already heard me introduce myself yesterday, so I'll just keep it short. My name is Deji, and I work with a company called Sahel Capital. And we've been in the food and ag investor space for the last 10 years, first through our growth equity fund, investing solely in Nigeria with the focus on driving value chain efficiencies, food security, and import substitution. Then much more recently in 2021, we got the mandate to manage another fund called CEFA, and that the mandate is across about 13 countries in sub-Saharan Africa, and that is basically to catalyze economic activity among smallholder farmers. And so, I'm happy to be part of this panel, and I think we'll get.
You know what? I will just actually start with DG in terms of the questions. So essentially, can you help us frame these issues around co-investment? I do know that you do have a number of funds that you've had to bring multiple partners on board, and you have a lot of experience in this area. Can you help frame the most difficult aspects of what your experience has been doing deals where you have co-investments or other co-investors on the deal? Can you give us help frame that convention so we can build on that?
Yes, sure, thanks. And I think I'll start by saying that in the first place, when we think about co-investment, generally speaking, it's much more than just putting together a large ticket size. Your own ticket size is not sufficient enough, but I think it's really about risk diversification. Looking at it from the point of view of the borrower, you're helping the borrower to diversify across their own, sometimes across their capital structure. You're helping them to diversify across multiple capital with different risk appetites. So I'll give you a very good example. We just closed an investment earlier this year in Ghana, and based on the need of this company, there were different use of funds that they had. And so because of that, there had to be multiple parties that came on board of that transaction. We had equity investors, which is closing right now. Then there was us that brought in both long-term and short-term working capital, which is a one-year revolver. But then there was another short-term working capital provider, but more like a 2-3 year amortizing loan. Then there was bridge finance. There's a TA component to it, and all these different instruments were addressing different use of funds by this company. And I think I found that very helpful for the company because they could adapt themselves very well, making sure that the money they were receiving was going specifically to address the needs. So if they needed money to finance, their warehouses and all that, they had that, long-term capex to do that. They had equity to expand into new regions, and they had the short-term working capital to finance the aggregation of the soybean, maize that they were financing. My conversation with them revealed that the biggest challenge that they've had through this process, and I'm speaking on the part of the borrower now, has really been engaging these multiple parties. The complexity of having to negotiate and have conversations with different investors, has become more or less like a nightmare, for this particular borrower. And I think as the conversation goes on, I think for me, what I really want us to drive is the kind of conversation I want us to drive is how can we enable the ecosystem to make it easier for these borrowers. Because if you think about it, the SMEs we're investing in, they are not as sophisticated as having those kind of people that have that level of sophistication to be able to manage these multiple moving parts with different investors. So the question for me, and I think we should be able to answer that here, is how can we harmonize as investors and present a face, to these borrowers within our region, such that it helps to lead to closure much faster, and it also leads to a lower cost for the companies that we work with. Hello, Martin.
Okay, but thank you so much. That's actually excellent framing for this topic. Really, it's about how do you simplify the range of processes that go into that borrowers need to deal with on the borrower side, and on the side of the funders need to also navigate. How do we simplify that to make it easier, to reduce the cost, to make it easier for the borrower, especially because borrowers are not as sophisticated in these parts, and they wouldn't have always the skills and capabilities to navigate all those complexities. How do we make it easier, right? So let me come to Brian. What are your thoughts on that particular question?
I think just before I answer this question, I just want to add to what Deji said, that the biggest challenge actually is the expectations of the investor, the data available from the company or whoever they are investing in, and then timing of the capital requirements. The challenge with African equity debt investment is mostly one person, maybe one investor wants another investor to sort of deploy first, or maybe come on a prior pursuit basis, etc. And we define co-investment as putting a capital in at the same time. It can come on a cascading basis, or we can really be very creative about, let's say, deploying a percentage that meets an immediate requirement, and then certain things come on board. We've been in situations where a co-investor was still fundraising, and it was no issue. It was no fault of the co-investor. But when we went to IC, we were prepared to sort of cover for the co-investor because we thought it was a good transaction that we could present to another investor to be able to solve that problem. And so for every specific opportunity, if we're able to understand the definition or the requirements behind what the co-investors want to be able to get a transaction done, then we could be creative around making sure that the deployment happens in a timely manner that doesn't frustrate the opportunity at hand. Because most of the time, right, sometimes these companies work on cycles. Somebody needs money to be able to sell, grow, and harvest rice by December, because 40% of rice consumption happens around Christmas or around festivities. So if you miss that opportunity, then the whole point of co-investment, right, is really sort of disrupted. What we have found is in different scenarios is that our fund is quite flexible. We're able to find third-party capital to be able to what we call bridge the opportunity. And then if the bridge delays, then we go back to our investment committee for what we call a follow-on opportunity. And then there are cases too where a lot of the funds, when you raise capital, you have what we call a co-investment right for your limited partners. Because if it's a good transaction that your investment committee approves, then there's a high likelihood that the people that gave you capital may be able to sort of co-invest for you. And their ability to co-invest with you actually increases your chances of being able to raise a subsequent fund if the transaction does very well. Because then from that point, you know that you have a 5-year direct relationship with the business in which you co-invest with other people with. So far as we get to a point where we're really flexible with timing and structure and also the data that we're getting from the company, then we'll be able to improve the whole co-investment ecosystem. Because, I mean, the whole point of this conference from day one has been, how do we strengthen the ecosystem just so social investors are able to be properly aligned with, capital investors. People who are looking for blended financing can be able to merge these financing in a manner that makes capital easily available to your sponsors or to the portfolio companies that you're looking to support.
Thank you so much. Thank you so much. You want to add? You want to add to that? Go on, please.
I'll add a little bit to what Brian just shared. So, from the limited partner side, sometimes they include these co-investment rights or clauses to allow them to be able to participate. But then, I think when you look on the African landscape, the issue, one of the issues is scale, right? So, for example, yesterday, I think Samuel talked about MasterCard investing between 1 to 2 million in investment vehicles, right? And so, say they put 10 million into an investment vehicle as a limited partner, and the size of the investment at hand, it's say $500,000. Seeing that most of the SMEs, their ability to absorb large amounts of capital really differs. In that case, I mean, MasterCard can't participate. You think of BII, you think of these other, big institutional investors like fund of funds. It kind of hampers the ability or the chances of co-investment. So I think scale of our businesses is also another factor that affects co-investments.
Thank you. So unfortunately, I think we are a bit time challenged. So Grace, as you contribute, I'd like you to help move us into the solutioning space. I think some ideas have already been put forward, but if you can give us a sense of some of the things that needs to happen that can actually improve, the co-investment ecosystem itself. Thank you.
All right, so I think the example that Digi gave earlier is a great example of sort of co-investing at the same time. So for one project, this is the opportunity. We structure it, to suit different investment needs, and then you move ahead. But I think that the aim of this conference, we're talking about impact and growing these SMEs from startup, early stage, to become giants. The aim is not to have 1 million SMEs all doing well. The aim is to have giants emerge, and these giants are the ones that are going to move the needle in employment, in GDP growth, and in a real sense on the continent, right? So the aim is to get as many mature businesses and as giants, unicorns, call it whatever you want, as possible. So with that lens, I think another side of, or another angle to look at the co-investment is not necessarily in co-investment at the same time, but throughout the life of the business, right? Now, every business at different stage has different kinds of risks, and different investors have different appetites. So I think what would actually I see as a need, as much as we need the co-investment for sort of a big tickets where we all come in together, or structured where you have your TA, you have your blended finance, and that's great. That's heaven really for an investor. As much as that is great and we need that, I think what we need is a line. It's like almost like an assembly line, to put it bluntly, right? Of a small fund manager raises capital, invests $1 million or $500,000 in a business. And if 2 years later they need $2 million, someone is ready and willing and without delay puts in that money till they get to a stage where they need $10 million and maybe they're going West Africa or regional. Someone puts in that money, in 5 years' time, we have someone who's ready to put in $50 or $100 million for it to become Pan-African. Then we are really moving the needle, because as much as, again, It's great to have SMEs all doing well individually and generating employment. All of that is great. But what we need are giants to come out of this. And I think that's the real opportunity for co-investment, where we are talking to each other. We are, it's not like I'm providing an exit for someone. It's like we are creating a giant together. Okay. And so you come in, I come in, I can put in the capital now. In 18 months, I need you. Are you willing to talk? Yes. If you hit this milestone, I'm willing to talk. So once we hit it, we get, and then over time, we build a behemoth. That's how Silicon Valley has developed. That's how the giants of the global marketplace have developed. And so I think we need to bring that lens to Africa as well. And I mean, related to this is even the way that the DFIs and so on invest in us. It's a club deals. Someone comes in, they come in together, number one, at the same time, so that's great. But even they're committed to you for the long term, right? So I mean, so long as you're performing decently, they will invest in your subsequent fund. If they can't, they'll pull in someone who can. And then you grow, and then you end up with very successful practices who can make catalytic investments that really move the needle. So I think that's another angle that can help towards the solution. That again, the solution is not just making an investment. The solution is creating giants and companies that we can be proud of on the continent.
Thank you very much. So I hear a long-term thinking and long-term approaches to how we do deal structuring. I hear need for some sort of information sharing that allows different partners to understand how a particular deal is progressing. I hear flexibility in terms of approaches. I think a number of themes are emerging from this conversation. Unfortunately, we don't have much time, so I would like to take a following questions from the group. Sam. You can have this one. I could move around the mic as well.
It's okay. It's working. Thank you to the panelists and everyone here. Just wanted to add a few points on the co-investment from an LP perspective. Two things. One is that when an LP is coming into an investment in a fund, co-investment becomes like a specific thing that is discussed. So we would agree upfront with you the kinds of things that we'll invest in. It will align with your investment strategy. So if your ticket size is the investment vehicles, as we call them, should also propose what their co-investment strategy is. Because it's good for the LPs to know upfront that, we do think we're going to deploy all the capital that has come into us, or 80% of it, taking away your management fees. But then this is where we see additional opportunities. And then you also give your LPs opt-out opportunities. So if you decide to go into, let me tread carefully here and say oil palm, and my funders do not want us to go into oil palm, then I can have specific sections in there to say I will not do oil palm investments because of A, B, C, D, and so on. So just to say that it should be a deliberate strategy of the fund manager to say, I want to do
I'm currently going through a difficult challenge with having alignment among investors in the same company. And so I think the panel should be able to maybe share some insights on how we minimize this potential for these, negative effects to show up, and when they show up, how we resolve it. Those who've already had practical experiences, maybe it would be helpful to share insights on how they navigated through that weary maze. But it can be very challenging.
Thank you very much. I actually think that this topic is one that requires a lot more time and depth to explore, obviously, because there are complications and they are real. And as Sam said, some of the I don't call it body. Maybe some of that responsibility sits with fund managers. To figure out the right investment strategies. That's prime them for proper co-investments from the LPs on their side. So that could actually help, ensure that they have available capital and they at when it's needed, and that the burden doesn't, the consequence is not really on the borrower. Anyway, we actually out of time, but I think Brian wants to make a quick response to that question.
I think we all have practical experiences when it comes to issues around co-investments. And that's why sometimes people resort back to the legals to figure out what were the intentions of the investments, etc. And some of the problems may come from the company in which you actually invested in and the data. And that's why I mentioned that data is one big challenge. Whenever we make an investment, there's always that diversion from what you think it was or your expectation on the company as it plays as a microcosm within the economy that it functions in. We've had an issue like that where we had to decide whether it was time to offboard the co-investor, because you have to look at how does it sanitize the whole situation for you. If you're longer term than the investor who's coming in and the expectations are different, and maybe they just have very sort of urgent cycles where the company has to pay back something to the investors, but you have a longer duration or you have a longer tolerance. Sometimes what happens is that you either look for another co-investor and then you allow yourselves to find a way to exit that other investor. It's not easy. I mean, these processes may take about 2 or 3 years, but I'll tell you about 50% or more from my data, about 50% or more of co-investment doesn't really end in the direction in which you want it to. Like, you need a whole longer sort of duration panel to be able to address some of these issues. Sometimes it may come from your debt financier. Other times too, it may come from other equity partners where their mandate is different from yours. And so you need to look at the definition of what was the status that brought them into the transaction and how do you mitigate that. That's just so it doesn't intoxicate or it doesn't destroy the value in which you're trying to create in a company. And so I tell you, the one practical example we had was an investment in Southern Africa where we believed in funding and what's it called, follow-on investments in the business for the long term, because we knew that the cycle, we knew that the timing for the investment was going to be longer than what the portfolio company actually presented. But then we're an investor that had a longer term cycle. And then if you completely exit the business, it was going to fall apart. So we had to go back to our investment committee to figure out how to sort of move the investment in such a way that two funds, one from our side, one from an outside party, can come and save the situation. It all depends on how best you think that the company has a chance of survival versus non-survival. And then ultimately, things are better than it is. But it's just like life. In any situation, you run into employee issues, management issues, investor issues, etc. But you just have to identify what are the key constraining factors that you can manage. And then most of the time, unfortunately, we go back to the legals to see what brought you into the deal and find a solution to it.
Thank you, Brian. Thank you so much. I really would love this conversation to continue. I want to know how much more time we have in reality. We just have 1 minute now. Okay. So, because there is a question that he has. Was it a question or comment? Okay. Can you take that? Because I want my panelists to have a minute to say goodbye.
Yeah. No, I was just going to say, with respect to co-investment, it's interesting. I think that there is a fair bit that the private equity impact investing space can actually learn from the VC space, because it's actually fairly commonplace in the VC space, but also in the sort of like infrastructure project finance space, where, which is where I cut my teeth. If you're going into a transaction and say the IFCs, the MLA on that, they are the MLA, and they are basically setting out the terms to say, guys, effectively, yes, they'll consult you, but here's how it's going to be, who wants in on this, right? And I think that there's room for that in the private equity space, because we all try to, structure a deal and be very bespoke about it. The truth is that if you're coming into a deal that somebody else is arranging, you have to understand that there isn't as much flexibility as there might be in a deal where you are leading. You know, so those are the terms. Who wants in on this deal, and then we move on. So that's the point I also wanted to make.
Thank you for that. Thank you so much. Okay, so one word comments as we say as we close the session. DJ, are you still on? Just
yes.
One
Yes,
quick
I am.
Final point in 10 seconds. And I'll go to Grace and Andrew. Go on. Oh, we can't hear you at all. We've lost DJ's sound.
Hello.
Okay, we can hear you now. Go on.
Yeah, so I was saying that linked to what the last speaker said, I think keeping it simple is the name of the game. I mean, the simpler we can keep, the terms, and the more harmonized we can be as investors.
Oh, we lost your sound again.
A lot easier.
Thank you. I think we got the gist of it. Grace, last final.
So I mean, just to add to Zubairu's question, that yes, we have had a situation like that. In every arrangement, you need a leader. We've had a situation where we want to exit and someone wants to stick around. We are the leader, unfortunately, so we are exiting. So to help make things simple, there needs to be a leader, and everybody sort of.
Thank you, Andrew.
I'd say that it's very important for us to deliberately create track records of co-investments to serve as templates with a long-term view, so that we can really help develop that space to make it easy for companies to get financing.
Thank you. Brian.
I think we should increase our appetite for co-investment. It de-risks the investment for a lot of everyone across the investment value chain. You being, if you're a blended financier, social impact financier, or commercial financier.
Thank you so much. Thank you, Brian. Thank you, Andrew. Thank you, Grace. Thank you, DG. And thank you for a wonderful audience. You've had good questions and interactions from you as well. I wish we could go on for longer, but we can't. I would say I'll have the last word, and I'll try to bring in AVPA into this. This is that I think just from this conversation that we've had, I think it might be a worthwhile thing to actually look into some study and some research that allows us to get into these questions with a bit more detail and do something that provides some knowledge that can be shared within the network. So AVP, as we said, is a social investor network, and hopefully these are the kind of learnings that we can help facilitate as we go on. So thank you very much, and I look forward to enjoy the rest of the session. I hope you've enjoyed this one as well. Thank you so much. Thank you.